Smart money concepts are supposed to make you a better trader, but let's be honest. For most people, they turn the chart into a chaotic mess of break of structure labels, change of character signals, liquidity lines, fair value gaps, and order blocks that look more like a coloring book than a trading setup. And that confusion is exactly why traders keep losing. They're drowning in information instead of learning how price actually moves. But here's the secret. You don't need to master 20 SMC tools to trade like smart money. All you need is one of the strongest concepts inside the entire framework, the fair value gap combined with the inversion fair value gap. When you understand the strategy properly, you'll see clean trend shifts, spot real institutional footprints, and enter trades with confidence instead of clutter. In this new script, I'm going to strip away all the noise and teach you a simple, powerful, skill-based version of the IFVG plus FVG strategy that finally makes smart money concepts easy, practical, and profitable. Step 1. Identify the real trend using breaks of structure. Before you even think about entering a trade, you must confirm what the market is actually doing, trending, slowing down, or preparing for reversal. And the cleanest way to read this is through breaks of structure. You're not guessing direction. You're letting price tell you exactly where the momentum is. When you see 3 consecutive bullish breaks of structure, it confirms that buyers are firmly in control and the market is in a strong uptrend. On the other hand, 3 consecutive bearish breaks of structure signal that sellers dominate and a strong downtrend is in play. This simple rule keeps you aligned with institutional flow and prevents you from fighting the higher time frame trend, which is one of the biggest reasons traders lose. When the structure is clear, your trades immediately become cleaner, higher probability, and backed by real momentum instead of emotion. Step 2. Wait for the higher time frame change of character. This is where the market reveals its true intentions. A change of character is the very first sign that the current trend is losing strength and a new one may be emerging. In simple words, change of character is the moment the market flips its behavior. Why this step matters. A change of character is the foundation of the entire strategy. It's the earliest and most reliable clue that the trend might be changing. Without a clear change of character, you're not trading a reversal. You are guessing. This step keeps your entries smart, logical, and aligned with institutional flow. Step 3. Identify the fair value gap created during the change of character. Now that the change of character has confirmed a potential shift in trend, your next mission is to locate the fair value gap inside the move that caused the change of character. When the impulsive candle breaks structure, it often leaves behind an inefficiency, a price area where the market moved too fast without balancing buy and sell orders. This unbalanced zone is the fair value gap. Here's why it matters. Fair value gaps act like magnets. Price almost always revisits these zones to rebalance before continuing in a new direction. They reveal institutional footprints. When big money enters the market, it often creates these imbalances. They give you a high probability point of interest. Instead of chasing price or guessing retracements, you simply mark the fair value gap created during the change of character move. This fair value gap becomes your higher time frame point of interest, the exact zone where you will wait for your refined entry. Do not take trades in the middle of nowhere. Always wait for price to come back into your higher time frame, FVG. When price enters this zone, you're looking for only one thing, a sign of rejection or slowdown. This is your first confirmation, but we don't enter yet. Once your higher time frame fair value gap is marked, it's time to zoom in and refine your entry with sniper level accuracy. Shift to a time frame that is 2 steps lower than your main chart. This gives you the perfect balance between detail and clarity. Examples: 1 hour to 5 minute, 4 hour to 15 minute, 15 minutes to 1 minute. when price enters your higher time frame fair value gap. The lower time frame becomes your microscope. This is where you observe how price starts reacting inside the zone, slowing down, rejecting, sweeping liquidity, or forming microstructure shifts that reveal exactly where institutions are entering. This step transforms a basic setup into a precision entry, filtering out weak trades and positioning you with the smart money. Step 6. Wait for a violated to flip into an inversion fair value gap. When price finally enters your higher time frame fair value gap, your job is to watch how the market reacts on the lower time frame. And this is where the most important moment of the entire strategy occurs. If price aggressively slices through a lower time frame fair value gap without pausing, rejecting, or showing any form of hesitation, that original imbalance immediately transforms into an inversion fair value gap, a powerful signal that institutions have stepped in with decisive force. This flip is not random. It tells you that the market has absorbed liquidity, invalidated the previous inefficiency, and created a fresh imbalance in the opposite direction as smart money repositions. A bullish fair value gap turning into a bearish inversion fair value gap means sellers have reclaimed the level with strength, while a bearish fair value gap flipping into a bullish inversion fair value gap shows buyers taking control. This transformation marks the exact zone where institutional orders are reloaded and the true continuation move begins. The inversion fair value gap becomes your precise entry location, a high probability, high efficiency point where you no longer guess direction, but instead align perfectly with the footprints of the big players who drive the market. Now that the inversion fair value gap has formed and the market has clearly revealed where institutional orders are being reloaded, it's finally time to execute the trade with precision. Your entry is simple and mechanical. Place a limit order at the midpoint of the newly created inversion fair value gap, allowing price to pull back and tap into the zone where smart money previously entered. This ensures you are buying where buyers stepped in or selling where sellers showed dominance, rather than chasing price after it moves. Your stop-loss placement is equally strategic. Position it just below the inversion fair value gap for a buy setup, or just above it for a sell setup, giving your trade enough room to breathe while still maintaining tight risk. This combination of refined entry and logical stop placement puts you directly in line with institutional flow, allowing you to enter with confidence and precision instead of emotion or guesswork.